Hey everybody, I'm Diane. I'm an enrolled agent with Grassroots Taxes, and I talk about all things tax, finance, and life. Today we're going to talk about new uses for your retirement money. And I know if you listen to me before, what am I going to say? Don't use your retirement money for anything. Don't take money out of retirement. What are you going to retire on? Okay, I say that all the time. Okay, so December 2022. The Secure 2.0 Act passed through Congress, and it allows you a little more flexibility on what you can do with your retirement money. They want to encourage more people to save for retirement, so rather than not put money into retirement because you might need it for something else, they're like, put the money in retirement and we're going to make it a little more flexible for you. So, what exactly did they make more flexible? If you have an emergency, if you have a kid, if you're the victim of domestic violence, if a disaster occurs, or if you get a terminal illness, you can use your retirement money. So let's talk about how. All these things have a couple similarities, although it's the government. They can't possibly make anything easy, right? Like they're not all going to have the same rules. They're all going to, every one of these instances has different rules, different forms, different everything. Okay. We're going to break it down a little bit, but what do they have in common? You can take money out for an emergency and you can pay it back to your retirement. You pay it back to yourself. Okay. That's a little bit complex because they are not loans. So if you have a traditional IRA that you're saving money in on your own, that's great. You put money in that. You need to borrow your retirement money. You borrow it, you use it, you pay it back. Right back to the IRA. Easy peasy. If you have a 401k with your employer, okay, now it gets more complicated because it is not a loan and you can't pay your employer back. Once you take that money out, it's out of your retirement plan at work. But the IRS allows you to put it into a different account, a traditional IRA, right? As a rollover, and you can put that money back. You pay it back to yourself, not your employer. You pay it back to your retirement. And all of them have a specific amount of time you have to put the money back. Let's talk about each one at a time. Okay. If you have an emergency, what kind of emergency? I don't know, something unforeseen, something didn't happen. Could be your water heater went out, car repairs, you need to take your kid out of school for a week and pay for an extra week of daycare. Who knows, right? It could be any kind of emergency. Section 115 of the Secure 2.0 Act allows you to take $1,000 out of your retirement, either from work or your own IRA, for any reason. Section 315, I think it is. There's another section that allows you to self-certify. That means you tell your boss, I'm having an emergency. Well, what is it? It's none of your business. I don't have to tell you I'm having an emergency. I need $1,000 from my account. You just have to self-certify. You do not have to give details as to why you're having an emergency. Okay, it's none of your boss's business. It's not HR's business, and it's certainly not the bank's business if you're getting money out of an IRA. You self-certify that you're having an emergency. You get $1,000 out. You have 3 years to pay that back into your retirement. Now, how often can you have an emergency? Like once a week, right? No. You get one emergency a year. One. If you have not paid back your last emergency, it is not a tax-free emergency. You can't take another $1,000 out and pay it back. How does the IRS know this? The IRS knows that you got a distribution. The IRS knows when you put the money back because you make a rollover contribution to a traditional IRA. They know you put the money back. If they audit, they're going to know. Okay? The IRS knows all this stuff. Every single one of these transactions is reported to the IRS. You might not see it, but the banks report it. They know. So if you have not paid back that $1,000, you get another $1,000 from your boss the next year. They'll let you take it out, but it's not going to be tax free. You're going to have to wind up paying the taxes on it. Now, when you have an emergency, you take out that $1,000, they're not going to take any taxes out of it. They're going to treat it completely as a rollover, and they're going to expect you to pay it back. If you don't pay it back at the end of 3 years, you got to pay the taxes on it. You're going to have to put it on your tax return and pay taxes on that $1,000. But you got 3 years to get it back. Pretty good deal. If you have an emergency, you can use your retirement funds. Next one, if you have a child, Section 311, Secure 2.0 Act allows you to take $5,000 out. So this also works if you adopt a child, okay? So, but it's only after the event. So a lot of times adoptions take a while to finalize. Child lives in your house for a while. You finally get, after the adoption's finalized, you can take $5,000 out of your retirement funds, borrow it, pay off the lawyers, whatever you need to do, and then you have 3 years to pay it back. If you give birth, it has to be after the child is born. Take out $5,000, pay off the doctors, pay it back into your retirement. Good way to use your funds when you need a whole bunch of cash, and a lot of people, they have a baby. What happens? It costs money, and it's not like you're going to work. You just had a baby, right? So you can take $5,000 out of your retirement, and you have 3 years to pay it back. Again, treat it as a rollover, which means they're not going to take taxes out when they hand you that check. They're expecting you to pay it back in 3 years. If you don't pay it back in 3 years, you're going to have to come up with the tax money for that $5,000, and that $5,000 is added to income. Okay, next one, domestic violence, Section 314, Secure 2.0 Act. Okay, if you are the victim of domestic violence, it's awful. I mean, it's awful. But if you think there's no way out, if you have money in your retirement, you can take out $10,000 if you're the victim of domestic violence. Do you need to prove that? Actually, no. It is not anybody's business. You do not have to prove it to your boss. You do not have to prove it to anybody. You can take $10,000 out of your retirement. It will, however, this one's a little different, taxes are taken out. They will withhold taxes for it. If you pay it back. Now, there's some other tax stuff you need to get in here. We're talking about $10,000. That's going to significantly change your income. That's reported as $10,000 extra income. That's going to, let's talk about, you're trying to get earned income credit, child tax credit. It could bump you out of qualifying for that stuff. So you need to really talk to a tax accountant before you do this, okay? Take $10,000 out. You can pay it back over 3 years. The taxes get a little wonky, but you can pay it back and eventually get the money. Taxes that were withheld, you get back as tax refunds when you file, right? Okay. Section 331 of the Secure 2.0 Act, I keep saying this, right, is if you are the victim of a disaster. What is a disaster? A disaster is federally declared, okay? You're going to be on the news. The Weather Channel guy will be there, okay? That's a federal disaster. It is declared by the president, disaster area. Tornadoes, earthquakes, okay, all that stuff. Fires. If you're in a disaster area, you can take out, get this, $22,000 to recover from the disaster. Same thing, except, oh wait, disasters already have a tax form, don't they? Yes, they do. Form 8915, huh? So this isn't just a self-certifying one. This already has a tax form, and it is not 3 years to pay it back. I mean, you do have 3 years to pay it back, but you have to pay it back ratably over 3 years, which means the year you take out the money, you owe taxes on a third, you owe taxes on a third the next year, taxes on a third the next year. You can either pay it back or pay the taxes on each third each year, but it's cut up into 3 years. Of course, none of these can all be the same, right? But as they get to be more and more amounts of money, the IRS is kind of protecting their interest. So taxes are withheld. You get $22,000 out, $4,400 is going to go to taxes, plus the state, so they're going to take taxes out before they give it to you. So be careful, but it is taxes taken out, so you don't have to come up with all the tax money. Okay. Last one. Another horrible thing. This is all horrible things I'm talking about today. Terminal illness. If you are diagnosed with a terminal illness, Section 326 of the Secure 2.0 Act says you can take out however much money you want out of retirement. If some doctor says that you are going to die in the next 84 months, that's 7 years, right? If you're going to die of something in the next 7 years, you can retire right now. You can start taking all your money out of retirement. Now, word to the wise, don't take all your money out of retirement in one lump. Just don't. Consult with a tax accountant, somebody like me, or another enrolled agent. Consult with someone before you take a large amount of money out of retirement. Don't ever take a giant lump sum out of retirement. You will be in a ridiculous tax bracket and you will owe it all in taxes. Take it out nice and slow. However, you can take as much money out of retirement as you want. If you take a bunch of money out of retirement, you go pay for some great medical care, you go to the Mayo Clinic or some other country or something, and you get better, you have an unlimited amount of time to pay it back, not 3 years. You can pay all that back into retirement if you took your money out, got better, and you're not going to die. You have the option to pay all that money back into retirement. So usually you're limited to what, like $6,000-7,000 a year to put into retirement, tax deferred. You can put it all back. You can put $100,000 in retirement in 1 year and take a tax deduction for it. They let you put it back. Now, remember, when you're taking money out of retirement, it is added to your income. So if you are on income qualified things, food stamps, right? Earned income credit, right? Disability, Social Security, okay? Those things, you can get kicked off. It will make your health insurance more expensive if you're getting marketplace health insurance. You could get kicked off of getting any benefits from that. So please be careful when taking a lot of money out of retirement. It could really make some big messes for you. Always consult with an accountant before you take out more than $1,000 or so, okay? So those first two, self-certifying emergency, which is like car repairs, hot water heater, okay, those kind of things. Take $1,000 out, that's not going to make a big difference on your taxes. That's why they don't withhold. If you have a baby, well, you just had another tax deduction, right? Right? Okay, $5,000 isn't going to make a huge bit of, big difference on your income. But the other ones, domestic violence, disasters, terminal illness, that could be a significant amount of money that could change your tax position. So please talk to a tax accountant before you take that money out. Let's put some back if you only need to borrow it. Okay.